It was my pleasure to be here with all of you this afternoon. Thank you so much for making the time during a very busy start of the year, I am sure. What I'm going to talk about today is a topic that is very dear to my heart, and in my personal opinion, is one of the most important, if not the most important topic to consider when putting together an investment portfolio. And that will be through international investment diversification. A little bit about the outline of my presentation. So first, I will talk about very generally, what does investment diversification mean? What does it mean to me? What are aspects that often get forgotten in this topic? And then in the second part of the presentation, I will talk a bit more specifically about my company, what we do, who our team is, the kind of services we offer. And then at the end, you will get the opportunity to get a free copy of my book, Swiss Money Secret, which has already been promoted by Urs. So if you're interested in learning more about Switzerland as a financial jurisdiction, make sure to stick around until the end to learn how you get your free copy today. So investment diversification. I'm sure a lot of you already have a basic understanding of what that means. For those of you who are not exactly sure what I'm referring to, I have here the definition as it is stated on Investopedia, and I'm happy to quickly read that to you. It says there, diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holdings or security. So what that says is basically that there are two components to diversification. The first one being that you have a diversified portfolio of stocks, so that you don't just hold one stock or a lot of similar stocks, but that you have a wide variety of different industries and sector that you cover. And then the other aspect that this definition covers is that you not only hold stocks, so not only one asset class, but a variety of asset classes. So for example, another asset class would be fixed income investments, bond, precious metals, real estate. There's plenty of options out there. Personally, I think there's a third component to diversification that is being forgotten in this definition by Investopedia, and I have brought to you a little analogy to show you what, in my opinion, is missing. And this analogy is related to fashion. So stick with me. I promise it will lead back to investing. What we can see here is a wardrobe with a t-shirt in the same size, in the same color. So if you have this t-shirt, if you have several of those t-shirts in your closet and nothing else, you're definitely much better off than not having any clothes at all. But you're still not fully dressed, and you still only have one t-shirt for one casual occasion. So that refers to basically very similar stocks in your portfolio. If you hold 3 Swiss pharmaceutical companies, that's still much better than not participating in the stock market at all. But you're not really safe, you're not really fully covered, and you don't really have a broad spectrum of investment opportunities. In other words, your risk is not being managed ideally. So if we say we have a variety of shirts in different colors made out of different materials that are suitable for a different variety of events, that is a lot more helpful than just having one t-shirt in one color. So if you have a stock portfolio consisting of several different stocks from different industries, from different sectors that have a different approach to risk, you're much better off than just having one stock or one group of similar stocks. But again, there's something missing. Even though you have shirts for different occasions and different seasons, you still don't have any pants, you don't have any shoes, and you don't really have a fully stocked closet. So what the definition of Investopedia basically says is you're best off if you have a fully stocked closet with different tops, with different pants, with different shoes, maybe even with a purse. So you are really prepared for any kind of weather, for any kind of occasion, for any kind of season. You do have something in your closet to profit off. And of course, that is a very good situation to be in. And on the first view, it might seem like you are ready to tackle the day. However, what happens if you lose the key to your house? What happens if your house burns down, or if you are away for the weekend? Then you don't have access to your closet anymore. And no matter how good it is, no matter how good the portfolio setup is, you're still having a problem. You're still facing a risk. And therefore, I believe the third dimension that should definitely be included when thinking about international investment diversification is that you build 3 fully stocked closets, or 2, or how many ever it may take, depending on your personal wealth, in different financial jurisdictions. And there are plenty of advantages to doing so. So what you can see here are 3 different fully stocked closets that all have a lot of different options. They have a little bit of a different emphasis. They're obviously in different houses. And to bring it back to the investment layer that we are here to talk about today, that for me means having portfolios in a variety of jurisdictions. So here I have an example. In my opinion, you're much better off having a portfolio in, for example, the US, in New York, maybe a safe nest tag in Zurich, Switzerland, and then another portfolio, for example, in Asia, in Singapore, or any other financial jurisdiction that is out there. There's a variety of benefits to that, and there's a variety of reasons why this is limiting your overall risk in your wealth. As I mentioned before, one of the advantages of having different portfolios in different parts of the world is that you have a different portfolio emphasis. So if you have different professional people in different parts of the world managing part of your wealth, you get access to different viewpoints. You get access to people who probably had a different education than you have, potentially have a different worldview, a different political viewpoint, and that really helps you have true investment diversification, much more so than if you just go to your friend who works at the local bank across the street. But there's other benefits as well. For example, you have an added layer of asset protection if you have part of your wealth outside your home country, especially if you're concerned about the political situation and concerned about anything else that might be going on in your house, in your home country. You can definitely profit from just having part of it in a safe jurisdiction, and that will help you sleep better at night. And then lastly, another important point, something that Switzerland is quite well known for, is you will have an added layer of privacy. So you will have enhanced privacy protection if you have some money outside of your home country. And then one of the most important benefits and one of the most important reasons why international diversification makes sense is that it is an option to hedge your currency risk. So for example, if you're based in the US and you have a US dollar portfolio, the US dollar has lost 9% versus the Swiss franc just in the past 12 months. If you compare it to a currency basket, it has lost 7% in the past 12 months. So even if your portfolio did have a great year and a great performance in 2020, if you held all of it in the US dollar, all of it in the US stock market, you have still missed out on an opportunity to make some money and hedge your US dollar risk with a multi-currency account outside of your home country. So there's a variety of options on where to move your portfolio, where to bring your money. There's many different financial jurisdictions out there, and most of them have a lot of expertise and a lot of different benefits and drawbacks. But today I would like to focus on Switzerland on one hand, because that's where I'm based and that's what I have the best understanding of. But on the other hand, also because in my opinion, it is actually one of the best options there are out there for wealth management. So what makes Switzerland stand out? First and foremost, Switzerland has one of the longest track records when it comes to wealth management in the world. People here started managing money in the early 18th century when people started managing the money of wealthy royal European families. So the experience that has accumulated over the past decades is unmatched. And then also Switzerland prides itself in being a country that is very easy to do business with. We have great infrastructure. We are very professional. We have integrity and are known for our punctuality. So we really feel that it is quite easy to do business with us. And then additionally, we have a fantastic educational system. So we do have the apprenticeship system, which means that a lot of people start banking at the tender age of 15 or 16, where they work at banks while at the same time getting their high school diploma. So you already have a lot of young professionals like myself who have a lot of working experience because they did not just start in the mid-20s after university, but they were able to work and gain relevant experience while at the same time getting educated. Then, of course, on a country level, the country is quite wealthy. We do have very high reserves and we have a very low level of debt, which is something that's increasingly important in the times that we are in. So, for example, we do currently have a level of around 40% debt to GDP. This is compared to, for example, the US, where the GDP has been, the debt to GDP ratio has been over 100% for quite some while. If I'm not mistaken, it's currently around 120%. So that's definitely something to keep in mind when looking out for a place to move part of your money. Then Switzerland also is extremely stable when it comes to its economy. So the past year with the corona pandemic has been quite difficult for, I would say, every single country on the planet. The Swiss economy has decreased a bit, but it was around 3% negative growth compared to its neighbors, Austria and Germany with negative 6% growth, and Italy and France with a negative growth of 9%. And then additionally to the economic stability, we also have a lot of political stability. We are a neutral country. We have avoided both world wars despite them being very close to our doorstep. We have only become part of the United Nations in 2002, and very important, we are to this day not a member of the European Union. So even though we are extremely central in the heart of Europe, we're surrounded by the Eurozone and the European Union, we are still independent and not part of the conglomerate. And then, of course, we also have very strict federal laws. We have a great deposit protection scheme. So you also know that the law is on your side and that you are being protected in the very unlikely case that something were to happen to the financial institution or the bank that you're bringing your money to. And then lastly, I've already briefly touched upon that. The Swiss franc is one of the strongest safe haven currencies on the planet. So it is definitely something that makes a lot of sense to think about moving part of your wealth into this safe haven currency. So what is it that we do, and why am I talking about Switzerland so much? We are based here in Zurich, Switzerland. We are an independent asset management company, and we are specialized in working with wealthy international clients who wish to diversify part of their wealth outside of their home country. Most of our clients are US connected people, so people who are based in the United States. Therefore, we are also registered with the Securities and Exchange Commission in the US. That means our company is being regulated not only by Switzerland, but also the US. The company was founded in 1991 by my father, so we do have an extremely long track record, almost 30 years of being in the international wealth management business. My husband and I are now continuing to manage the company after my father retired at the end of last year. And what we do is we help clients move part of their wealth outside into a European private bank. So we do have partner banks in a variety of countries, in Austria, Liechtenstein, and also here in Switzerland. I will talk a bit more about them later on in the presentation. Once the account is set up, we will then the client will issue a limited power of attorney to our company so we can help them build a diversified portfolio that will act as a safe nest egg for them and help them sleep better at night. So our team is quite large. We do have my husband and I and Julia, who are responsible for the managing of the clients. My husband Urs is responsible mainly for the investments. I myself am more focused on the strategy and the business development. Julia is additionally to looking after clients, also assisting in the compliance department, and she has a lot of expertise when it comes to retirement money. Then we have our in-house compliance officer, Daniel, who makes sure that we adhere to all rules and regulations. And then we have Robert, my father, who is the founder of the company, who still acts as an advisor. He's not operatively active anymore, but he lets us use him for his wealth of knowledge and expertise that he has built up over the past decades. And then lastly, we have our food officer, Henry, our little French bulldog, who comes to the office with us. So what is it that we specifically offer? We do have two types of services. The first one, our main service, is the asset management that we offer. Our minimum investment size there is $500,000. We do charge a management fee of 1.5%, and that includes the setup of the account and then the setup of the portfolio, including the rebalancing and the ongoing cost communication with the client. The client is there free to choose any of our partner private banks. They will receive a tailor-made investment portfolio that is really tailored towards their risk tolerance, towards their time horizon, towards their specific needs and beliefs. They will receive quarterly calls from our office to discuss the portfolio. They will receive a quarterly report from our office, quarterly bank statements, a yearly tax statement, of course, and they also can get an access to the account over our online platform if they wish to do so. And then we also have our permanent portfolio. This is also a discretionary asset management mandate. However, the main difference there is that it is a standardized portfolio. So every client who starts with the permanent portfolio is invested in a similar way. It is a low risk to moderate risk portfolio consisting of direct investments into stocks, bonds, foreign currencies, and precious metals. The minimum investment size there is $250,000, and the management fee is 1% a year. Our main banking partner there is Bank Winter in Austria. As I mentioned, the mandate is standardized. We still do have yearly calls in order to discuss the portfolio. We also offer the quarterly company reports, the quarterly statement, and an online access and tax statement to the account. Very important is to note that both of those services are available for a variety of accounts. So you don't just have the opportunity of a personal account. You can also use our services for a joint account, for an individual retirement account. This is referring to US retirement accounts, but also asset protection structures like trusts, LLCs, and foundations. Whichever setup and whichever account suits your needs best is usually determined in a complimentary call where we discuss your personal situation and see which bank, which service, which account type is best for your specific situation. So if you're interested in discussing any of that in more detail, or if you have any questions of whether or not our services could be of benefit to you, please do not hesitate to reach out. Send me an email at info@whvp.ch. I'm happy to answer any questions there, or of course also later in the Q&A section. But usually a personal one-on-one call is best to determine what makes sense and what doesn't. So here we see the 4 partner banks that we work together with. I have listed them in alphabetical order. We do have Bank Winter in Austria, in Vienna. So that is a bank in the Eurozone. They have been founded in 1892, so they have been in business for a very long time. They have been a long-term partner for our permanent portfolio. They are doing a very good job there. We have Kaiser Partner, who is our partner company in Liechtenstein. Liechtenstein is a tiny neighboring country of Switzerland. They only have 30,000 people living there. They also use the Swiss franc as the nation's current currency, and they have an even lower debt to GDP level than Switzerland. I think their debt is virtually zero. I think the debt to GDP level is around 0.5%. So a very interesting jurisdiction as well, especially if you're looking at Swiss wealth management in combination with a Liechtenstein banking jurisdiction that, again, increases the international diversity of your portfolio. Then Bank Vontobel, a very well-known private bank here in Switzerland. They have also been in business for almost 100 years. We have had a very long working relationship with them. They are mainly our partner for people who wish to have their banking in Switzerland as well. And they do a tremendous job in working with US clients. And then lastly, we have Wiener Privatbank. They are also a great partner based in Austria, just like Bank Winter. They are our main partner for individual retirement accounts. They have a long standing tradition of working with IRAs. So that is certainly a valued partner as well. And now, as promised, if you're interested in learning more about Switzerland, Swiss wealth management, how diversification can benefit your personal situation and your portfolio, please make sure to reach out. Send me an email to info@whvp.ch. Just write book or ebook in the in the email, and I'll be happy to send you a copy for free, just for educational purposes, that you can learn more about the topic that I covered today. That was it from my side. I would be happy to answer any questions you have, either right now if you have time, or later on in the Q&A session. Thank you so much for listening.
Well, thank you, Jamie, for the presentation. Very much appreciated to get this information. I'm always pleased to hear good news about Switzerland, my country, which you did very well indeed. Well, there are some questions for you. And question is, the question is for Bitcoin. Bitcoin is a lot in the news, and it has gone up, it has gone down. Then lately it has gone up very, very much. Then it came down again. Do you touch any cryptocurrencies, or you say no, that is too risky, too speculative? I will leave the hands away from it.
Yeah, I mean, the cryptocurrency topic is an extremely interesting conversation to have, I think. And it's a question that has come up a lot in 2017. And now in recent weeks, it has come up again. From like a professional investment point of view, I am personally not touching it, just because there is no way of evaluating what would be a appropriate number or whatnot. From my personal perspective, it is just driven by speculation. And I believe if that's something that interests you and you have some spare money that you wouldn't mind losing, it's certainly something that's interesting to look at. But I don't think that's something that you need a professional investment advisor for, because what we do is we look at the investment case, we evaluate what would be a fair price for an investment, and then we decide whether or not it fits into a portfolio. At the current time, this is not possible with Bitcoin or any other cryptocurrency, because there's no underlying value. So I think it's definitely interesting to watch how the price develop, watch how speculators are making or losing money. But from us, from a company perspective, it's currently not something that we're looking at.
Okay, thank you. Then another question is, could you please flag asset classes or geographies, locations with the most upside potential for 2021? Which countries, which areas would you put your eye on?
Well, that's quite an interesting question as well. Of course, that's something that we think about a lot on an ongoing basis. I think at the moment where I see a lot of potential is in the commodity stock sector, because I believe that there will be much more infrastructure projects from the governments to support the economic recovery worldwide. And then, of course, always interesting in times of unrest and political turmoil is precious metals, specifically gold. Gold did have a good year last year, but I believe that there's still more upwards potential. So that's definitely something we like to have in our portfolio. Also, from a diversification point of view, gold is usually negatively correlated to the stock market. So that means if the stock market goes down, the gold price often goes up, and vice versa. So we believe that can make a lot of sense as well. And then in combination with the gold price, we also see some more potential with mining stocks. Having said that, mining stocks can be quite volatile, so it definitely has to be looked at very closely. And again, the stocks need to be diversified quite well. I hope that answers the question.
Okay, well, thank you. And then a question from Alex. Ways to achieve investment portfolio diversification. How does it work? How do you put this diversification into it?
Yeah, I mean, that's basically what I've covered over the past couple of minutes. I think one of the most important points is just to have a variety of stocks in your portfolio, a variety of asset classes in your portfolio, and if possible, and if your financial situation allows it, also a variety of financial jurisdictions. I think that's how you can achieve that best.
Okay, you mentioned before that you have a lot of clients from the US, I guess.
Correct, yeah.
And my experience when I was a banker, it was very, very difficult to open bank accounts for Americans. And you mentioned now places in Switzerland, in other places. There it is now accepted. They accept.
Yes, luckily it has become much easier. What I would recommend if you're an investor from the US, you definitely need to be making sure that you work together with someone who is SEC registered, because that shows you that the person really has the US market on top of their mind, that they understand how the US market works, that they understand how the rules and regulations work. But if you go through a registered investment advisor, it's definitely possible to open up a bank account here in Switzerland. And that's what we have been doing for 30 years, and it has been possible and doable for all those years. And I'm sure it will continue to be possible and a good option for US investors going forward.
Okay, thank you. And then if somebody wants to open, there's a question, if somebody wants to open a bank account in one of those banks, do they need to go and visit the bank, or is it possible by correspondence, or how do you do it?
It is possible by correspondence. So I'd be happy to give an outline over the account opening process in a first telephone conversation as well. We will identify the client. We will need a notarized passport copy, but it is not necessary to come here to Switzerland, which is extremely helpful, especially in the current environment of travel restrictions. Unfortunately, I haven't been able to travel to the US for a year now. So we're very happy and glad that we can offer account openings over correspondence.
Okay, then a question from Natalie, whether it's possible to open bank accounts in Austria for non-residents.
Yes, that's definitely possible. So the vast majority of our clients are still living in the US. So even if you're not a resident in Austria, it's still possible to open up an investment account there. If you're interested in that option, feel free to reach out, and we can talk about your specific situation and whether or not we could be of help.
And then Matthew has a question concerning your portfolio return in 2020 for your permanent portfolio.
Yes, so for the permanent portfolio, we do have some numbers to give out to. For the tailor-made and individualized portfolios, that's a bit more difficult because they're not all invested in the same way. We have made a performance of slightly over 20% in the past year.
Okay, and a question, how do you navigate around negative bond yields?
Yeah, that is a very important question as well. We, as a company policy, we don't make any investments into investment products that offer a return that is lower than what the client pays in fees. So the whole fixed income sector is extremely challenging at the moment. What we are looking at, we do have a couple of good fixed income investments. What we're also looking at is corporate bonds that are being issued in emerging market currencies. There we still have some yield and also some upwards potential depending on the currency. So that's something that we're looking at, but having a developed market currency and the highly rated corporate bond, it's almost impossible to find anything that makes sense.
Okay, and what is the minimum amount to open an account? Question from Acosta.
So, for the permanent portfolio, it's $250,000. For the asset management mandate, it's $500,000.
And do you have any opinion concerning investing in China and Chinese companies?
I think it's a very interesting investment case. I'm not a specialist in Chinese investment opportunities. I believe the renminbi has performed quite nicely, and there's a lot of interesting companies there. So yeah, that's definitely something we're looking at. It's definitely something we consider using in our portfolios as well. As of right now, we're not invested in China, but as I said, it's definitely something that might change over the not too distant future.
Then a question from Mahmoud. Would you give any guarantee if somebody gives money to you and gives up the mandate to you to invest, that you say, okay, we guarantee a return of something?
No, no, we don't do that. And I don't think that should be done by anyone, because we don't have a crystal ball. We do our very best to put together a diversified portfolio. We do our very best to put together a risk management strategy. We talk closely to our clients to make sure that we put together a portfolio that reflects their personal preferences and risk tolerances. But I don't think that any serious business person would promise any returns, because that's just not something that we can promise. What we do make is we do have some expectations management. So we are very clear on what we hope to achieve. We are very clear on how we hope to achieve it. But in the end, for example, the coronavirus pandemic, if things like that happen, that's just not possible for anyone to foresee.
Okay, and then the last questions from Batbold. Do you look at the opportunities in emerging markets?
Yes, as I mentioned, emerging markets are quite interesting. Again, it's not our main focus. Our main focus is the Swiss and European market, but especially in the fixed income sector, we watch emerging markets quite closely, and we have made quite interesting investments in those markets over the past couple of months. So yes, I think it makes sense to look at emerging markets and see what kind of opportunities lie there.
Okay, well, thanks a lot, Jamie, for the presentation, and also thanks a lot for answering those questions and there were quite a lot of questions to you, and I do hope that this is also a good indication for the interest for you and for your company and for your services.